Joining me now is David Morrison. Handshake, please, sir. There it is.
Good morning.
It all begins with a handshake. And so you've got Morrison Financial.
That's right.
That was started 4 years after I was born. I'm dating
Wow.
myself here.
Wow.
So you know a thing or two about lending on real estate.
I think I do.
We're going to get into it, and also we have Chris in the background, who's a good friend of mine in a real estate. Well, Chris is a little bit more bearish on real estate, which makes it. This is going to be a really good interview because he's going to come with more of a bearish approach.
If it doesn't end in a punch out.
That's right. If we don't have a big fisticuff.
Yeah.
So we're going to take a drive here, and we're going to find out a little bit more about you first.
Sounds good.
So, how did you get into real estate lending or even finance?
So, by way of background, I'm a lawyer by profession. I only practiced for 3 years with a downtown firm, actually not too far from here. We're in downtown Toronto right now.
Yeah.
And I knew in the first 15 minutes that I was not going to be practicing law as a career.
Can we pause you there?
Yes.
So you did all that studying.
Yeah.
What was it about, being a lawyer you didn't like?
I liked being a lawyer. I didn't like the business of being a lawyer. I didn't like the business of keeping track of my time and my hours. I remember telling my wife she wasn't my wife at the time, but she became my wife.
Yeah.
That the only other place I can think of that they do that is in prison. They take a piece of chalk and they mark on the wall the time going by. But that's what you had to do in the legal profession, was keep track of your time, and that's how you build clients. And I found it was a business formula that was not attractive to me for a whole host of reasons, and I still hold that view today.
Right.
I think that the legal system is inaccessible to many people because it's become too expensive. Nobody's happy, the clients aren't happy, the lawyers aren't happy, and costs too much to the client, and the lawyers aren't making enough, and it's just a bad business model in my view. I realize that it works for a lot of people, and I have many friends who stayed in it and are doing very well. So,
one of my favorite quotes of all time is Warren Buffett's right-hand man, Charlie Munger, has a quote, and he says, "Show me the incentive and I'll show you the outcome." And so right there, a lawyer's incentive is to bill hours.
Well, you're right about that. And, lawyers talk a lot. There's rules in the profession about avoiding conflicts of interest.
Right.
But the biggest and most glaring conflict of interest is that exists between the lawyer and his own client. Mm-hmm. Because if the case settles quickly and early, that means less billings.
That's right.
Many lawyers have sufficient
methods.
Well, they have sufficient new business attraction, so to speak, that they can live with that, and they'll always got another case.
Right.
But there's always going to be circumstances where a lawyer's conflicted. He wants to see it go just a little longer because it's a good income for him. So, they don't talk about that. I'm not really here to talk about that, but it's a business model that wasn't attractive to me. So in 1986, I found myself practicing, but spending a lot of time looking for what I was going to do next. And I hit upon the finance industry at the time, which was, it was a different time. In the mid-'80s, you probably won't know this, but for a brief period of time, the conventional financial services industry, being our major banks, took leave of their senses. And they were financing secondary financial companies, nothing wrong with that, but they were financing secondary financial companies on terms that were extremely generous and have not been replicated since 1990, the recession of the 1990-92. And they were giving leasing companies 7 times equity, it was just crazy. But that was the world that I grew up in, and I got the idea that I could, with no money, start a financial services company and get the banks to lend me the money. And you know what? It happened. It happened. I left my law practice. I started the company in '87. I won't mention the name of the banks, but I went to some of our major banks and I said, lend me some money so I could relend it. I'm simplifying the story, obviously.
Right.
They did, and before you know it, I had a financial services company. We started off in commercial finance, mostly on what's known as factoring. Factoring is the purchase of invoices of small and medium-sized businesses to accelerate their cash flow. Within a short period of time after starting the business, we diversified into loans to condominium corporations that had to do major repairs to their buildings. If you want, it would be a big diversion, but I could tell you about that. And then shortly after that, as a result of a relationship with one of our major institutional partners, we got into mortgage lending. And that is mortgage lending to builders and developers has become our major business at this time, predominantly because it allowed for the growth of a portfolio because the loans were longer term. In the factoring business, the financing arrangements tended to last for a relatively short period of time, and it was hard to layer them on top of one another. So we gravitated towards the mortgage business, and that's where we've excelled over the last 30 plus years.
And recently you launched 2 funds to get retail, that allow retail investors to get access to the space.
That's exactly what it is. It's for people who want to follow the activities of our company. Historically, what we did was we would originate a mortgage opportunity. We would bring in investors, institutional and high net worth investors, to participate. And Morrison Financial, which is a registered, licensed mortgage administrator, would manage the loan as trustee. Sometimes with our participation, sometimes without, and that was the business model. It still is a big part of our business, but it's not the only part. The problem with it was that investors would come into a mortgage, and they'd be paid out when that mortgage was finished.
Right.
And we would find another opportunity, but there could be a gap of 3 or 4 or 5 months.
Yeah.
And when that money's sitting there doing nothing, investors wanted to keep their money continuously deployed. And so what we started, these funds, they're called the Morrison Financial Senior Mortgage Income Fund, the Morrison Financial Junior Mortgage Income Fund. And people don't invest in the mortgage directly. They buy units in the mortgage trust, and it goes through a limited partnership into a mortgage portfolio. Your money stays completely deployed all the time, and you don't worry about a mortgage paying off or not, when it pays off or whatever. When you want to redeem, you put in a redemption request, and your money comes to you typically within the next 30 to 60 days. Sometimes a little bit less than that.
So let's talk a little bit about your philosophy here, because this is not a get rich quick thing. This is the opposite of speculating in a stock market and stuff like that. This is, in your opinion, basically a guaranteed path to becoming wealthy, or keeping wealth and compounding it. So it's your thing. You want to kind of take over from there?
No, but that's exactly it. I mean, you have to go into it and stay into it and let the money compound, and you'll certainly end up beating inflation, and you'll certainly end up wealthy over time. But it's not going to be like somebody tells you, 100% in 30 days, and it's not a get-rich-quick scheme. But I think it has a very high degree of certainty associated with it. And I stop short of saying it's guaranteed, because
you can't.
I won't. I'll never say that. I do want to mention something, though, because you touched on it, ETFs and other such investments. Ours is not an either-or investment. Okay, I would never tell anybody to take 100% of their net worth and put it into one of my funds, or both of my funds. And you know what? Our exempt market dealer would not allow you to do it, even if you wanted to.
Right.
They have restrictions based on securities regulation that are designed to make sure that people remain diversified. So I don't go to anybody and tell them you should do this and not do that or whatever. I say consider us for part of your portfolio. Okay, the best investors are siloed. They have a pool of money, whatever it may be, even very wealthy people with 100 or 200 million. They don't put it all into one thing. What they do is it's a stratum, okay? It's a range, okay? On the right-hand side, they keep a certain amount in cash at all times, just in case emergency, kids need something or whatever. At the left-hand side extreme, they've got wildcat drilling and stuff like that. They're going to make a fortune in 3 days, and then score it rich. And then there's everything in the middle. There's large cap equities, there's small cap equities, there's T-bills, bonds, and we would like to be a small silo in your portfolio whatever percentage is right for you, 5, 10, 15%, and we're going to be in a higher yield instrument that's less secure than a GIC, but more secure than a small cap equity, and somewhere in the spectrum is where we want to reside. So, people say, should I do this or should I do that? I say do both, do all, just find a way to diversify your portfolio accordingly.
And
so,
your funds are registered, so someone with an RSP or a TFSA can
yeah. Now, when they invest through an RRSP or a TFSA, the investment will be technically through a trustee.
Right.
The trustee can be your own investment advisor, RBC Dominion or National Bank or whoever is your advisor. In the case of the major banks, you're going to have to sign special forms because they like to keep you in their own products, and they'll try to resist you to go elsewhere. But if you don't have a trustee, we'll set you up with Olympia Trust, which is a common one, or Questrade we work with, or NCBI, which is National Bank. But you absolutely can invest through a registered fund.
And your two products, your yield there is on the junior side, I think is, if I remember correctly, 9 to 10%, and the senior part of your portfolio is 7 to 8%.
Yeah, so that's the way it is right now. Our funds follow prime rate.
Right.
If prime rate goes up a quarter point, you can typically expect that your yield will go up a quarter point, but not necessarily immediately in lockstep.
Right.
Okay, it's because we price our loans to our borrowers based on prime, and the interest is passed through in accordance with the formula. If prime goes up, the global amount of capital available is going to go up, and a higher amount is going to pass through to the investor. When we price our loans on prime, against prime, we typically do a floor at the time that the loan is underwritten. So what happens is that if prime then goes down, our borrower, unfortunately, is stuck with prime where it was, and it creates a floor on the price of the loan at the time that he wrote the loan. So when prime goes down, our yields to our investors will not necessarily go down, except slowly over a period of 18 months, and they'll start to catch up to where prime has gone down because they're protected by the floor in that interim period.
So I've got a few questions, thoughts, and I know that, again, there's a lot of regulatory stuff here, things you can't say, whatever. But you started this business on leverage, correct? Borrowing and lending.
That when I started, yeah.
Okay, so there's a lot of people my age that got into real estate 10 years ago and are sitting with, $300,000, $500,000, $800,000 of equity, sitting there doing nothing.
Right.
And I'm not a fan of equity or cash doing nothing.
Right. Yeah.
So, do you think that it makes sense for someone to, and again, regulatory stuff here, you have to watch what you say. But if someone has $500,000, right, of equity, and they have to borrow, they take a HELOC, they want to, they do an equity takeout of that of their house, right? Do you think that it makes sense for them to go into your fund?
I'm not 100% sure that it would make sense to borrow money just to lend it into our fund.
Right.
Okay. I every situation is individualized, but you know what? We work with a company right now called Belco Capital. They're the exempt market dealer.
The EMD, yep.
Yeah, they're the EMD that manages compliance with investment guidelines, Securities Act, into our funds.
They do all the KYC.
They do all the know your client, suitability, and they assess that. I don't know exactly what they would say, but if a person said, I don't have money, but I got equity in my home, and I'm thinking of borrowing against that in order to invest in this income fund, I think that they would probably look askance at that. They would not probably restrict it completely if a person really wanted to do it, okay?
But they would maybe advise them on it again.
They would advise not doing too much of it.
Right.
And so would I. And it's really, our product is really one for savers, not borrowers, you know. Would I like to have people borrowing to put it into the funds? Sure, I suppose,
Yeah.
But, it's a... I wanna also mention something else, which is really important, okay?
Yep.
Securities regulation makes us define our product as high risk. I personally don't think it's high risk. That's a personal opinion.
Yeah.
I'm not allowed to say it like in a way that
Yeah, you can't
I can't
sell it,
okay? When you talk to our exempt market like an exempt market dealer, they're going to tell you it's high risk, okay?
Right. That's, yeah.
They're required to because it's an exempt market product, okay? I have a lot of issues with that, okay? I don't get it, okay? But you don't need to be told that to invest in a Canopy Growth Corp, even though it went from $24 billion market valuation down to less than $500 million in the space of 2 years.
Yeah.
That's high risk, okay?
Yeah,
But
I
they don't-
participated in that.
Yeah. I hope on the good
On the
side.
upside.
On the upside, well, I have family members who did as well, and they did very well by that.
Yeah, but
The
I
companies-
get your point.
They never made any money. Like,
It's speculating.
yeah, it's complete speculating. That's high risk. So but they have their construct, and they are the regulators. And a guy who I went to law school with happens to be the current CEO of the Ontario Securities Commission, and we're good friends and we love each other. And it's their world, and I just have to comply. So is real estate lending risky, or is it not? If it's done properly, I don't think is a general category. It's a risky category of investment. But please understand, when somebody gets to our exempt market dealer, they're going to have to see the words high risk.
Yeah.
So
If we can, let's talk a little bit about, I know that your formula and the system that you have in place is to not worry about the things that I would like to discuss right now. But if you don't mind, I'd like to deviate away from that and kind of just get your general thoughts on Southern Ontario real estate. Not New York, not Australia, not Winnipeg, Southern Ontario. Because it's a very specific market. It has there's a lot of reasons for that, like especially the Golden Horseshoe, which is kind of, sorry about that, it's kind of landlocked in my opinion with this greenbelt. So right now when it comes to affordability, it's not very affordable. Unfortunately, the supply is very low, right? So when you look at your loans, I know you don't want to go above 75 to 80% loan to value, totally get it. That tells me that you see 10 to 15% downside risk, plus your administration and lawyer fees to cover if you have to take back the property and cover loan. That's kind of what it tells me.
Right.
But some people, like Mr. Christopher back there, when he takes over, I think is a little bit more bearish. And I look at the data of why affordability is where it is, and it's like, well, who can afford these homes? Even if we are bringing in all these new Canadians and letting in immigrants, right? But it's like, how can they afford it? So what's your opinion? I've said a lot there. You take it from here and say whatever you want.
Well, it's hard to answer. I don't run my business from a macroeconomic point of view.
Totally understand.
I curate each individual loan in accordance with the criteria that are in front of us and the facts that are in front of us right at that time. And I'm not a great fan of the pundits that we read in the newspaper that try to explain what's going on and are continuously wrong, about where we're going or what's going to happen.
Yeah, that's noise to you.
Yeah, it's just noise, and it's a distraction, and we pay attention to the individual facts in each individual case. But, I think that it's really hard to make broad statements about what's going on, because I think that there's a lot of different factors at play. I do not understand the theory or the practice of what the government's been doing, what the Bank of Canada's been doing with the increase of interest rates over the last couple of years. I don't understand how exactly that really tames inflation. It tames the parts of inflation that they're measuring,
right?
But it doesn't tame the other parts of inflation. So yes, the person goes to a grocery store and he spends less on bananas, but he's spending $3,000 more on his mortgage. Is it capturing that whole dynamic? Why was inflation where it was going? I have my own view of why it was going where it was going, and I'm not 100% sure that it has anything to do with interest rates. But I'm not the guy in charge, and I'm not the guy making those decisions, and we have to live with those decisions. But I find it very hard to make macroeconomic statements about where we're going with housing. If I could predict all of these things, I'd be the richest guy in the world. If I could predict where interest rates are going, where the prices of houses are going. Yeah. What I can tell you is this, okay? There's a dramatic shortage in Southern Ontario right now. Dramatic shortage. What I can tell you...
This is what I want to hear. I want to hear your opinion.
It's a dramatic shortage, okay? What I can tell you is that there's demand for product, notwithstanding high interest rates, okay? You got to watch what product you're involved in. I would stay away from any kind of vanity real estate right now, okay?
Like Drake's home.
Like Drake's home. My home in Toronto is only 10 blocks away. Of course, it goes down by $2 million a block, okay? But yeah, I watched that whole thing be built, and I'm fine for Drake, but I would be staying away from it from a financing point of view. I wouldn't finance it, and I wouldn't want to be the owner of it right now. And if investment is my criterion, and so that's good. I don't finance vanity real estate, and I think it's going to be challenged in the short term. Mm-hmm. And I even think higher end real estate that's not necessarily vanity, but is in the multi-million dollar categories. I'm not worried about product that's below $1 million or even up to $1.5 million. I think there's always going to be a ready market for that. There's a gigantic transference of wealth going on right now. That
sounds good.
I am not certain is factored into these economic decisions of the Bank of Canada, and I don't know how it can be measured by the powers that be, and yet they respond to it in things that they do. So I believe that one of the forces of inflation that was driving inflation so much was that we have the baby boom generation that's like an elephant going through the body of a snake.
Right.
And it affects everything that's going on. Right now, the baby boomers have collectively accumulated trillions of dollars that are sitting up in investment funds and retirement funds, passive money that they're savers. They're benefiting from the increase in interest rates.
From the industrial age mindset, right? That's where they made their money.
Exactly, but their children are in their child rearing, house buying, trying to send their kids to school, do all that, send them to camp, stage of their lives.
Right.
And what's happening is that, and by the way, I'm a boomer. I'm a sort of a mid to late stage boomer. I'm 67 years old. I'll be 68 in May, okay? But everybody I know in my generation is helping their kids.
Right.
I help my kids with their first home, and my friends are helping their kids, and this is a source of money that is creating a kind of inflation.
Right.
I don't know that interest rate increases are really dealing with that.
Well,
okay?
Especially when you have the supply issue. This is like Southern Ontario again, right? Like, or you're just saying abroad?
I'm saying everywhere. Baby boomers are transferring money to their wealth, in Southern Ontario in particular, to their children, and that's where a lot of the inflation is coming from, because they can just keep bidding up, and they could just keep bidding up. If the money's coming from mom and dad, it's not about the bank, and it's not about that. Now, at some point in time, any mortgage that the kids are going to have to assume, interest rates become relevant. But I think that this was largely what was going on, is that the baby boom generation is supporting its offspring in purchasing homes, and it was creating a lot of inflation and other products, and it was creating a lot of inflation, and it's going to continue. That force is going to continue, notwithstanding higher interest rates. It may slow a bit, but it's going to continue until something happens, and that's we start to die in big numbers.
Right.
And that's about to happen. Okay, so I'm 68 years old.
Well, you still got like 30 years. Come on.
No, I've had many friends that have unfortunately passed early.
Right.
Okay, because this is the age at which you start to hear about stories. He got this, he got that, she got this, she got that, and but what's going to happen in the next 10 years? I will probably not go 5 business days in a row without hearing about
A
somebody
lot.
that I know that's gone. And 10 years from now, 15 years from now, it won't be 5 business days. I'll hear about it every day.
Yeah. So you'll have
And
funerals in your calendar.
I'll have funerals in my calendar, and that's the way it'll be. And that money will transfer, and it will get quickly soaked up, and that passive money supply will no longer be around. And at that point in time, I think we'll probably see permanently increased interest rates. Sort of like what I grew up with. When I was in university, I took economics 101, and we had to do any kind of modeling. Everybody threw in 10% interest. That's what it's going to cost. Cost of money, 10%.
Yeah.
Because that's what we grew up with. That's what we saw.
Yeah.
Everybody thinks interest rates are high right now.
Yeah, they're
Okay,
yeah.
but the truth is they're way lower than they've been through not the last 20 years, but through much of the last century. And you know what? People still bought houses. The economy still went on. There was still construction. Everything continued as normal. There was no doom and gloom. In 1981, prime rate hit 21%.
Yeah.
The world kept going.
Yeah.
Didn't stop. So
A lot of people had to give up homes and nail their keys in. But
if you were a borrower, you were in trouble. If you were a saver, you loved it.
Yeah.
Okay, and it's just. But life went on. Okay, it wasn't all doom and gloom. And the things that I worry about as to whether or not life is going to continue and what it's going to be like, it's not the price of houses and it's not interest rates. I don't even worry about that even for like a second. I think we got to worry about much more. How do we learn to live together, as a world?
Yeah, I get
what
it.
is this war in Russia and Ukraine all about, and why is that going on? And are we going to destroy ourselves because we can't share the resources of the world? Now we're getting way off topic.
No, but I love it. I don't mind. That's what this the morning drive is about. It's just talking.
Yeah.
I would like to do a little segment, and I'm going to give a shout out to Nick West of the West Group, who is a mortgage broker and also a real estate agent, focusing mostly on new construction condos. So shout out to you, Nick. Chris, can you open your phone there? And Nick gave me 3 questions for you. I let Nick know that I was interviewing you. He looked at your website and your profile, and these are the questions that Nick came up from you. So,
from your condo financing business for older condos, are you seeing a lot of cases where the condo corps are poorly capitalized? If so, do you see higher than normal condo fee increases down the line, or something even worse?
Okay, so if you want to talk about my condo finance business now, what I'm talking about here is I'm talking that my company lends to condominium corporations money to do major repairs to their buildings. And this product is predominantly addressing the fact that the vast majority of condominium corporations are not putting enough money into the reserve funds, which are the funds that they are required to maintain for long-term maintenance and repair and replacement of the common elements of the building. And so when they find they have a big expense that has to be addressed, the only solution is often to borrow money in order to ease the pain on the unit owners. Now, this problem is a problem that's existed for a long time. I did my first loan in 1992, and I've been doing them steadily since. The problem, in my opinion, is not going away. It's only getting worse, and it derives from one aspect of condominium in particular, and that's that in our culture and in our society, most people look at condominium ownership as a transient state. We're going to live in this condominium after we get married until we can afford a home, a single-family home or a townhouse or a ground level. We're not going to live on a slab of concrete high up in the air forever.
right.
I'm going to move into a condo when I'm old and don't want to maintain my house until I go into a senior's home or until I die, maybe. But this is not a long-term prospect for me where I'm going into this for 10, 15, 20 years. Why do I want to put money into a fund to replace a roof that will not have to be replaced for 20 years?
Okay.
In condominium, whenever a board or the unit owners have to vote on anything that will impact them financially, I can predict the result of the vote every time. It will always be whatever results in the lowest monthly payment now.
Right.
And what results in the lowest monthly payment now is putting the minimum possible into the reserve fund today, because it is really there to address long-term repairs and maintenance, and that's what it's restricted for, okay? Long-term repair and replacement of the common elements. It can't be used for anything else. So there's tremendous resistance there, and that dictates that absent increased legislation that has more teeth in it, condominium corporations will perennially find themselves, more and more of them will find themselves short of funds to do major repairs to their buildings. And when those repairs are necessary, they're going to be confronted with either special assessments where everybody has to come up with a big amount of money. In many cases, people won't be able to do that. Even if it's only $3,000 or $4,000 or $5,000, remember, it's after-tax savings.
Sure.
You know, a lot of Canadians don't have that just sitting around. And so they'll either have to deal with a special assessment, or they're going to have to take a loan to deal with it, or figure out a way of doing the work in stages if that's possible. All of those things will result in some measure in higher unit owner costs on a monthly basis. And some corporations will learn, and they will become very sophisticated at budgeting the reserve fund and preparing for it. It just means they're taking the higher cost now.
Yeah.
And they won't go up. But one way or another, these things have to be paid for. And I have a great concern. And my concern is that if the problem is allowed to get too much out of hand, it will be a blight on our society. Okay? In other words, if buildings are allowed to fall into a state of disrepair because people choose not to do the repairs, as opposed to raising the money, borrowing it, or doing a special assessment, eventually you're going to find one of these buildings finds the wrecking ball. And there's already a few candidates right now in Toronto.
Right.
I won't mention any,
Sure.
okay, but they're in severe financial shape and severe physical shape, and will ultimately probably have to be torn down. I'm very concerned about King Street. It became a style in the 1980s and beyond. You're seeing the buildings now to do glass curtain buildings. Mm-hmm. It's all windows.
Yeah.
You know those buildings, the green and the blue windows like that. Okay, so I don't know how long those glass curtains are designed to last. Okay,
Right.
but I don't imagine it's more than 20 years. Maybe. I don't know. Engineers can tell you. But wait till all those glass curtains have to be replaced. Every window in the condo has to be replaced, along with the roof.
And are they planning for it?
Are they planning for it? I don't know. I don't know, but I think not.
That's a great question, Nick West, and thanks for that. What's Nick's second question, Chris? If you can please speak up.
Nick's second question is, have you seen an uptick in purpose-built rental financing?
Yes. Period. Yes. Right now, purpose-built is what a lot of people want to do, and we've been financing more of it than we have historically in the past. We're very careful that we will only do purpose-built rental in markets that we think are very vibrant and underserviced for rental product.
Can you explain what that is, what the purpose-built is?
Purpose-built rental is a building that's built as an apartment building as opposed to being sold off as units, condominium units.
Got it.
So a person's going to build the building, they're going to own all of the units in the building, and they're going to have a management company that leases out units in the building to residential tenants, and they're going to get income from that, and etc. There's a big demand for that kind of building right now in Southern Ontario, generally speaking, in the major markets. There's not enough rental housing, but in particular, there's not enough affordable rental housing. So what the builders are trying to do is make smaller units, and hopefully that makes them affordable. The purpose-built rental market, to the extent that there's a shortage of it, has historically been serviced by the condo market, investor condo market.
Right.
So people are buying condominium units in the hope of renting them out and making money and covering their costs. And so there's a lot of people in these downtown condos that are renting units. That's problematic right now because you can only, I think right now in condominium, and I'm not in it, so
Sure.
you got to be careful. I think in many cases it's upside down right now. So you cannot rent a condominium unit for as much as it will cost you
Yeah, your
to
negative cash
maintain
flow.
it, your negative cash flow. So you're relying on the value of the unit to go up in
Speculating.
order to make it a good
You're
investment.
buying canopy?
Yeah, in a proper investment scenario, you'd like to have positive cash flow and be making income while the value of the unit's going up. I think at this particular moment, I think historically people were able to do that. Their return on an annualized basis on the cash flow was only maybe 1 or 2%, but the unit was going up in value, and overall it worked well. Right now, at this point in time, I think that approach is stressed. I think it will come back. I think it will come back, but it's stressed by the high interest rates, and it's stressed by the, it doesn't matter what you or I think.
Right.
It matters what the big banks think.
Yeah.
Because if the big banks will not give you a mortgage to buy the unit, you can't buy the unit.
That's right.
You understand? So what happens is, now we're passing a building now that's being built, a condominium building. If you look out the window there,
Yeah.
I think it says QA condos or something like that. So that building's only getting built because a certain number of the units have been pre-sold.
Right. The risk has been taken out.
The risk has arguably been taken out. Arguably.
But what
Okay?
do you need? Are we just talking about a letter from a bank saying I'll give you a mortgage?
Well, that's a good question, because what's happening now is the builder has pre-sales, okay, and this particular builder has been able to go to somebody to finance that construction because he had pre-sales. What's happening now, right now, okay, is that the banks that do the construction financing, and including the non-banks like my company, we're starting to take a really close look at those pre-sales.
Yeah.
And we're starting to ask ourselves, will they stick?
Yeah.
In other words,
Will
when
they
it comes
qualify in 3 years when it's a
2 or 3 years, will they have the money to be able to close on that deal?
Yeah.
And everybody's conservatizing their approach. They're making assumptions that a certain number of them won't be able to, so they want the builder to have more equity.
Yeah.
Okay, and you know what? It's not simply the banks. The builders are concerned about it too.
Right.
Okay, because they're stuck with a loan at the end if they can't sell the units. So this is going on right now. I'm hearing that up to 20% of projects are temporarily on hold.
I've heard as high as 30, but yeah.
Yeah, and they're just not doing them right now.
Which again,
Yeah.
it just throws in the more bullishness to the supply demand, the simple economics, right?
It
doesn't help that.
It doesn't help that. And, but at the end of the day, it's going to balance out. It's going to balance out. And at the end of the day, if they're not building as many condos, then they need more rental units. And so people are building purpose-built rentals, where I think it still works.
Yeah.
The formula still works. But eventually that could get, saturated, and the rents might be too expensive. I'm not too worried about that, because the more rents get out of hand, the more our government will develop programs to help low-income people and stuff like that. It just seems to be absolutely necessary to remain in office.
Yeah, we can digress on that.
Yeah.
So why don't we get to Nick's third question? Nick's third question.
Third question is, for land development, low-rise in particular, are your clients intentionally postponing bringing product to market? If so, what are the main reasons why?
I have not seen any postponement in low-rise. I've seen postponement in mid-rise condominium, but we in particular haven't seen it. Now, we are not a gauge of this completely, because we only see a certain segment of the market. I don't finance the biggest and the best developers. They go to the banks.
Right.
Okay, I don't finance Great Gulf Group. I don't finance Mattamy. I don't finance Tridel. I don't finance Minto. These are multi-billion-dollar corporations, and they have banking relationships that they are able to secure, and that's fine. What I finance is higher quality B-tier builders and developers, and they might be in that category not because the opportunity is more risky, but because, for example, if they go to RBC to get construction financing, RBC won't consider them if it's not their fourth project.
Right.
They want to see 3 projects under their belt
Yeah.
before they're going to do it. So a guy's got to get started. His first project, he might be extremely competent. He might have worked for another builder for many years, but this is his own company now. It's his own project. He needs to get started. He comes to what we call a B lender, which is what we are.
Yeah.
B is not necessarily associated with higher risk. It's just B. You know, it doesn't qualify for the bank. Where to go when the bank says no? So we're seeing actually more opportunities in the current market.
And the spread between A and B right now is the lowest it's ever been.
It's the lowest it's ever been. I'm getting the opportunity to finance opportunities that 1 or 2 years ago the bank would have done readily.
Yeah.
So we're getting better quality opportunities and more of them because the banks have over-responded. The banks are forced by the nature of who and what they are to manage based on macroeconomic measurements, and we are able to curate deals as to their individual criteria. So the specific answer to the question is my company has not seen less of that. And my company has not seen less opportunity in that space. But on a macro, maybe it's going on. You know, I don't know what the bigger low-rise developers are doing. I happen to have a brother-in-law who's active in that space, and he's never been busier than he is today. Now, he sees that as good and bad.
Sure.
He's also around my age, and he's working harder than he expected to be working at this time.
Yeah.
But he's got 300 or more houses on the go right now,
Yeah.
and he can't stop until they're finished.
Right.
So he tells me.
So thanks, Nick West, for those questions. If anyone is in the real estate, is looking for a home, pre-construction, or even a mortgage, you can give Nick West a shout out, and we'll put his bio and information in this video. I have one last question for you. It's totally off of lending, and then I'm going to hand it over to Chris. We're going to park it and let Chris drive for a bit. Would you want to be a landlord in Southern Ontario or in Ontario?
So I am a landlord in Southern Ontario, and I'm in the process of selling off my assets, my rental assets, for a number of reasons, but mostly because we were positive cash flow. We did very well on the capital increase, on the capital value increase. Yeah, appreciation. But we were positive cash flow throughout, and recently, because of the rise in interest rates, we're not positive cash flow. And I said, oh, then now's the time to sell them. I'm not going to wait for a further increase in appreciation. We got all the good stuff of that, and so we're doing it. I personally don't like being a landlord. But
especially in Ontario.
But some of the richest people in our country have made their money by being landlords, okay?
Right.
You just have to be, am I allowed to speak French?
Yeah.
You just have to be prepared to put up with a lot of shit, okay? You know, like really, okay?
Yeah, I know.
You know, we have something called the Landlord and Tenant Board, okay? Landlords are bad, tenants are good.
Yeah.
It's so
I know,
stacked.
It's just
in
like the
favor
condo
of
market. Right?
Yeah, you know, it's so stacked in favor of the tenants. You know, I don't know if you ever saw the movie Pacific Heights, okay, but worth a watch if you're considering being a landlord, okay? Yeah. Michael Keaton or whatever. It's about the tenant from hell and the difficulty they had getting them out, and ultimately the place gets destroyed. But that can happen.
Yeah.
It can happen.
And you can't get him out for 15 months.
And what I have found is in the houses that I own that I've rented, although I've done okay, I've done well, I found that at the time of termination of the lease when I'm going to sell,
really nice?
typically have $10,000 to $20,000 of expenditure, and these are modest houses,
to get it back up.
to get it into a place where I can sell it.
Right.
Okay, so I'm giving back, let's say, all the last year's rent.
Yeah, last year's
Okay, so when I count my return, I have to do that, and it's because people won't maintain a place the same way as you know that they rent. Now there are some exceptions. If I was going to be a landlord today, I would say that the most important criterion would be to pay attention to who I lease to.
That's right. The character, just like
character. Yeah. Same with borrowing. Pay attention to the character of the person you're lending to.
Without saying a specific neighborhood, I'm not asking you that, but what part of the GTA, or assuming you're even in the GTA, were you a landlord in?
I wasn't in the GTA. I was in Brantford and I was in Kingston.
Okay.
And these were townhouses, low-rise townhouses. And you know, we did very well because we've had them over the last 10 years. They've more than doubled in value. But we were cash flow positive in the last year or two because we do use financing for them.
Sure.
We found that we couldn't be, so we didn't want to, you know, we couldn't leverage that appropriately. So we just started selling them. We had 14 houses and we're down to about 5 left.
Okay.
5 or 6 left. And that's it.
I'm going to give you a handshake, but this interview is
Okay.
not done.
Okay.
Chris is going to take over, and he's a fantastic investor, and he watches real estate pretty closely. He has a little bit of a different thoughts than I do, which is totally cool.
Good.
And so next time when I snap my fingers, I'm gone, and here's Chris.
David, it's great to be with you.
Thank you. Thank you. Pleasure to meet you.
Pleasure to meet you. Yeah, your speech, it was great. I really loved it. I wasn't expecting it to be what it was, in the sense where, you know, Carl and I follow real estate, but we find that typically, you know, it's either like a really strong bull message or a really strong bear message. It's one or the other, and you've got a very level approach to it. It's a really level formula, and it's nice to see that.
So when you talk about my speech, you're not talking about the part of the interview I just did with Carl. You're talking about the speech at the Money Show today?
That's right. Yeah.
Okay, good.
Yeah, absolutely.
Yeah.
Yeah. So that was great.
Yeah, thank you. Thank you very much.
So,
I had a lot of people running up to me at the end, and so I sent them to our booth. I didn't try to field all the questions.
Yeah, I could see that. We ran out of time there.
Yeah,
But we spoke to the people at your booth, and they were great as well. So yeah.
Very good.
So you've been doing this for longer than I've been alive as well, which is it's always great to gain a perspective from individuals who've been through a few cycles and whatnot. And I was wondering if you could share with us what it was like kind of going through some of these down cycles, early 90s, 08, so to speak.
That's a great question, you know, because my attitude has changed over the years as I've sort of ripened and matured, right? But I used to follow everything that the pundits said in the newspaper. You know, I'd read the Globe, I'd read the National Post, and, you know, I would just soak it up and try to adjust my behavior accordingly. And I just found that so often it was just wrong, or I just couldn't do that. And what I had to do is I sort of had to march to my own drummer. And I don't get excited by anything these days that I'm told on the macro level. Oh, interest rates are going up, this is going to happen, that's going to happen. You know, after the COVID-19 lockdowns in March, the prediction was that residential real estate would do a nosedive.
Yeah. Oh, yeah.
That's not what happened. It went the exact opposite.
That's right.
You know who that prediction came from? The Canadian Mortgage and Housing Corporation. Go back and look. I'm not making this up, okay?
The experts.
Who could be more sophisticated and more expert than them? But they predicted it would go down, and it skyrocketed, okay? Now, it did level off and come back a bit in February 2022 and has done all kinds of things since, right? But I just can't follow the pundits, and I can't just do by what Ezra's read on the front page of the newspaper. And as I've mentioned previously, my response to all of this is to curate every opportunity in accordance with its own facts, circumstances, and its own situation, its own people. Who is this guy? What does he want to do? That's how I respond to everything. So,
wow, it sounds like a really measured approach. So speaking of interest rates, is there a healthy level that you would like to see interest rates at, in your opinion? Or is it just kind of determined by the market?
To me, it doesn't really matter. Okay. I have a business that services investors, and they always like to get higher returns. I have a business that services borrowers, and they don't like to pay higher amounts. I really think it's part of the exercise of evaluating in each individual opportunity. We always look for a budget line item that shows interest cost in our borrowers. Our borrowers are builders and developers. We want to see what are they expecting to pay for interest, and we make sure that it's realistic, and we make sure that they build in a contingency for more, just in case things get delayed or interest rates go up during the term. And if the number is satisfactory and realistic, will support the project, even though the interest rate is maybe higher than what he would have paid a year or two ago. Typically speaking, not always, your danger point is where a borrower has locked in his sales, but not locked in his costs or her costs. Got to watch it these days. There's a woke movement, you know. If I say his costs, I can't do that. I got to say his or her costs, right? And that's, or their costs, you know. I got to watch my pronouns, right? Yeah. So the point is that I'm not making fun of that, but it's just for an old guy like me.
We gotta, it's changing times and
difficult thing to do, you know. For an old guy like me, I'm used to saying his costs or, you know, whatever. So the point is, if you've locked in your sales price and you haven't locked in your cost, you got to pay very, very close attention, and we watch those situations very closely because the revenue can't go up, but the cost can.
I see.
And
so, I mean, of course, there are ways to hedge, say the price of lumber and whatnot, like through the futures market and whatnot. Is that something that you look at your borrowers to do, or?
The answer is yes and no. Okay, if I'm doing a substantial project, I will not finance the project if the borrower has not locked in 70% of his major costs.
Okay.
So if there's pouring of concrete foundation or garage, or there's steel assembly, or whatever are the major costs, I want to see them locked in by a fixed price contract. So I don't have to worry about that. Now, having said that, when you get to smaller projects and smaller builders, or you get to certain market circumstances, you just can't get locked in.
I see.
You can't get locked in, okay? It just, nobody's going to give it to you. There's too much play in terms of the commodities market. And at that point in time, you have to make judgments, and you have to be careful to make sure that you're dealing with borrowers who have more equity or who can sustain a cost increase if it should happen. And they'll naturally benefit if there's a cost decrease, which has happened too. You know, price of lumber spiked a few years ago after COVID, okay, and it came down precipitously when the pandemic lockdowns and the supply chain issues started to pass. So, everything's cyclical, and you just got to be careful. Again, for us, it's curating each and every opportunity in accordance with its individual facts.
That's great. Yeah.
Yeah.
Do you have a favorite asset class outside of real estate?
Real estate's it. Real estate lending is it. That's my asset class. And it's disturbing sometimes because if you were an investor and you wanted to put 100% of your money into real estate lending, exempt market dealers won't endorse that and won't allow you to do it. If you're a permitted investor, you have more than $5 million, you can do whatever you want. Okay, permitted client they call it. Okay, but they'll try to restrict you from doing that. And I think that real estate lending will never let you down, personally, if you do it properly. Okay, so I like it. I'm not a fan of the stock market. I don't know if we've talked about that in this car, but I did talk about it in my speech earlier today. I don't invest in the stock market. I know how people have gotten wealthy sort of doing that, and I understand the concept. I completely endorse the concept. I don't endorse the market as it operates today because I think it's been hijacked by an intermediary group of investment bankers and advisors and all these institutions that sort of control what goes on there, and I think it has a tendency to favor those institutions at the expense of retail investors. And I will not back off this position, but I will have a more detailed debate in maybe another environment if you want on that, because a lot of people disagree with me, but I just don't understand it, so.
Yeah, and it's great to, you're obviously very good at what you do, and you've got a wealth of experience. And you, during your speech, you mentioned you had about 16 staff, is that right?
That's right. And they're doing things like, if a person comes in and wants to borrow money for a real estate project, we ask them to make a presentation to us. We request certain information. So we have analysts, and if he says, I'm going to sell these units for $1,200 a square foot, what our analysts will do is they will look at the units, they will look at where they're located, they will look at the quality and the finishes of the units and the building, and they'll go into the marketplace and they'll search the area in which the building is located, and they'll look for comparable product, and they'll try to understand whether this guy is dreaming in colors or whether he's got a realistic perspective on what he's going to sell the units for. They will do the exact same thing with his costs. We have a big database built up because we've dealt with a lot of developers. If the guy says this is going to cost me $80 per square foot, we will test that assumption against the reality as we understand it, based on comparables against real deals that are going on right at this time. So we know what the guy next door is paying for drywall. If he doesn't have a realistic price for drywall, it's not going to work. Okay, so our staff are involved in analytics, like they're analysts that are looking at the information that we're being fed and measuring it against the opportunity and coming up with a recommendation as to whether or not we should do the deal. We have relationship managers, people who are doing business development out there, trying to develop new relationships so we get new opportunities, and they also will be involved in writing up the commitments that we give to our borrowers and instructing counsel. We have a CFO and we have administration associated with the operation of our funds. It all adds up to about 16 or 18 people, and I'm one of them. So I'm the least smart of the group.
Well, you're certainly a guiding force, and I'm sure they learn a lot from you every day.
My time is spent these days trying to nurture and develop a 30-something group of executives that have joined my company. You might have met some of them today or seen some of them today, into people who in the not too distant future will run the company on a day-to-day basis. Some of them already have equity. A few years ago, I ceased to be a sole shareholder of the company. I started giving out equity to senior people with the company. I'm glad to have partners these days. Some of them will be taking over in due course. Will I retire? No.
Never
retire. Will I adopt a less active role in the company? That has already started. So I'm not writing up commitment letters these days, and I'm not writing up credit memos. I'm reading them, I'm not writing them, and I'm providing comments, and I'm acting as a resource to my young executives, and I'm enjoying watching them grow into these roles, and I'm going to support that and support their future ownership, and I'll stay as an investor until they roll me in a box. That's a euphemistic way.
Yeah.
Speaking of my passing. Yeah.
David, thank you very much.
Thank you very much. It's
By
been a
far
pleasure.
one of my most enjoyable interviews of all time.
Thank you.
And where can people find you?
They can find me, first of all, I have a strange habit. I actually give out my cell number.
Oh, don't do that.
416-786-1004. I don't hide from investors. I don't hide from people. But they can also reach me at dmorrison@morrisonfinancial.com, or just look up on the internet my website, or the company's website, Morrison Financial, and they know where to reach me. So they are welcome to do that. I don't really have anybody I'm hiding from today. So
fair enough.
Thank you.
All right. Thank you very much.